Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Chris Mayer of Woodlock House Family Capital.
I've known Chris for decades now. He's a great guy and a brilliant investor. Please take notes. This is one of the folks I really want you to learn something from. Okay, so get out your pen, get out your paper, type on your computer, wherever you take notes. Get ready to do it. All right, so let's do it right now. Let's talk with Chris Mayer. Chris Mayer, welcome back to the show, man. It's been a while.
Yes, it has. It's been a long time, Dan. How you doing?
Yeah, I just checked. It's been since August of 2021 here on the podcast.
Wow.
Yeah.
Okay. A lot's happened since.
Yeah, I mean, a lot's happened since last
it's
Monday.
Like two bear markets. That's like 2 bear markets ago.
That's right. It's been a busy time, hectic time for investors, and it's getting more hectic every day, it seems.
Mm-hmm.
But I thought, I was thinking about how we should start this out because you and I have so much history. We could start it a million different ways. But since it has been almost 4 whole years, I wonder if you would indulge me and begin by reminding our listeners, what your core investing principles are, including your code that you've told us about before, because I think that's a really good thing. I hope they take notes when you talk about code.
Yeah, so that was an acronym that I developed to kind of capture some principles I wanted in the investments I look for. So the C was for cheap. So basically you're looking for something that is going to be worth a lot more in the future. And that's kind of fundamental. And the O is for owner-operator. I'm investing in companies where there's skin in the game, where the management team or board or somebody owns a lot of stock. And that's probably one of the most important ones, especially over a long period of time, get those incentives aligned. The D was for disclosures, which is just, are the public disclosures good enough for me to kind of understand what's going on? Is it not, overly complicated? Are there red flags in the way the company's organized? So that covers that kind of thing. And then E is for excellent financial condition, which covers the balance sheet financial strength. So for me, I don't invest in companies that have any financial leverage or have minimal financial leverage, and they all kind of work in sync. You need all those things together. So those are the core principles, but the basic idea too is to hold on to these things for a long time. So there's very little turnover in my portfolio. It's buy and hold, and that's it in a nutshell.
Yeah, I think the incentives you talked about, the incentives play into the other 3, don't they? Well, the other 2 anyway, the disclosures and the excellent financial condition, because if you're handling your own money, you don't want to lie about it and get in trouble. And
that's it. That's it. So when you have that, I sometimes say like that part of it is the most important, the alignment and the skin in the game, because that covers a lot of other things. You don't have to worry about it as much. And it's true that there's a lot of empirical studies about this as well, but companies where there's, let's say, family controlled companies where there's a family that owns a large percentage of the stock, those companies tend to be less leveraged than their peers.
Now, one thing I wonder about, I've never really studied those companies as a separate group, although when I happen upon them, I say, oh, okay, that's good. But since you're focused on them, have you noticed a tendency to sort of allocate capital in a more careful, long-term manner, like doing the right thing when everybody's panicking, and not doing the wrong thing when everybody's euphoric, that kind of thing?
Yeah, I would say that's definitely true. Of course, there's always exceptions on both sides, but as a general rule, definitely if you own a lot of stock, you're less likely to dilute yourself by selling shares. You are also more likely to invest when others are fearful. So when a hired hand really sees no particular upside to sticking his or her neck out and investing when things are bad, the owner, thinking much longer term, will be more likely to do that. So you definitely see that. There's anecdotal evidence about that those kind of firms invest counter-cyclically. That's a big one. The lack of dilution we talked about, that's another big one. So yeah, and the other thing I think it comes up to is focus on R&D. So a lot of times these companies will invest more heavily in research things that don't pay off for years to come, right? Well, that's
Mhm.
again where that long-term mindset comes into play. So there's a lot of things that it leaks into, and I think over time I've come to appreciate more and more how powerful that is, because it also affects how you incentivize people, how you pay them. So a lot of times these longer term family oriented companies, they're just better at keeping good people, paying them. I know for a specific example, like Brown and Brown is a company I think you have in the portfolio too. I'm not sure if you still have it, but
We
I've
sure
owned it
do.
since
Yeah.
I've had it since inception of my fund, and I think you started buying shares around 25, and it was 125 until recently. It still might be like 110 or something. But that's the
Hmm.
company where the Brown family owns a significant amount of stock, and the CEO is the grandson of the founder, and there's a certain ethos there about how they think about incentives, and there's lots of stories of people who have gotten wealthy there as well, becoming shareholders of Brown and Brown. People have worked there, sold to Brown and Brown, stayed on, and so that kind of legacy, those things I really look for, and those tend to be marks of very successful companies.
It's cool. I have to say, it's cool to find companies where, in extreme value, I often like to start out the report by discussing the history of the company. When I find that it has something to do, that it bears upon how they're behaving today, that's gold to me, because when things change and they get a different type of management team, and then they're not doing so great for a while, and then they come back and they get another management team. Oh, we're doing better now. It sort of muddies the waters for me a little bit,
Yeah.
but I deal with it. But I I like it when there's a straight line from the founding to the present
Hmm.
in terms of the management continuity. It just gives me a sense of conviction that I don't think I can really get any other way. Like, I've got these two high conviction sort of natural resource plays, the last place you'd ever want to get conviction, because I know the management teams and I'm really highly confident that they're going to behave well through the cycles. And they have. They've
Hmm.
behaved brilliantly through the cycles. And,
Yes. Yeah, I mean,
and
companies do have a kind of DNA, and that gets set really early
yeah,
and persists for a long time. Look, yeah, absolutely can be messed up, but it takes time. And
right.
if you do have that kind of continuity, and uh, yeah, that's a good sign.
Yep.
Good
And
sign.
it doesn't have to be family member. It could be like Costco, right?
Absolutely. No, it
Um,
doesn't. It could be, ranks from within. It could, and you see it in different ways. You could look at, sometimes I'll look at like turnover, and that's an interesting thing, because sometimes you'll see like a top performer in an industry. Let's say like Old Dominion Freight Lines, which is in trucking, which is an industry which is notoriously difficult to find drivers, keep drivers. I mean, their turnover is far less than the industry average. They train most of their own drivers, and it's the way they manage it too. When times get tough, they don't let go of their drivers. They keep their drivers, but maybe they have them work on the docks for a little while. They still pay them the same amount. They're still treated well, but they still have them. So when that demand rebounds, they can put those people back as drivers. That's also a family-run organization, or was family founded by a family, but has since kind of stepped away. But you still have that culture, and you still have the people, who've been promoted to executive offices, CEO, and so forth, have been there for 20 years or longer. So again, to your point about there being kind of like a golden thread from the founding on to the present.
yeah. Is this something that you discovered on your own, or do you have were you influenced before you even started investing other people's money and before you were in finance? Like, where does this knowledge of this come from for you?
Yeah, that's a great question. I mean, I think it's like slowly built up over time, because I started my career in finance, in banking, as you know, corporate banking. And in that world, you know, you get to know the businesses very well, you get to know the people very well. And we always did these deals, we'd have personal guarantees. The founders of the businesses would have to sign on the loan personally, that they were responsible for paying it. If it didn't work out, we could, in theory, go after their personal assets. So I just saw the power of that over a long period of time, especially sometimes when things would go south. Uh, and I retained that. And then I know, he's an obscure, not as well known financial writer, but Martin Sosnoff wrote a couple of books that are long out of
Yeah.
print that I really like. One was called Humble on Wall Street, which came out in I think 77 or something, not 78. And the other one was A Silent Investor, Silent Loser, which came out in, I think they're in the 80s, but again, out of print. But this is a point he would emphasize all the time, is the power of having management skin in the game. And one of his phrases was entrepreneurial instinct equates with insider ownership. It's one of those things I always remember, which he's always taught and emphasized this aspect of
Is that
managers as problem
EIEIO?
solver. Yeah, there you go. It is, isn't it?
It is.
Entrepreneurial instinct. Holy
Oh,
cow!
wow.
I never knew.
I will never forget that.
Yeah,
now.
I never realized that.
Hopefully.
Entrepreneurial instinct equates. Yeah, so there you go. But that was another influence along the way. And then, then my own personal experience. I remember particularly through like the '08 crisis, you'd see some of these management teams that didn't have skin in the game would, I thought they were a little quick to raising capital, when maybe a more creative team that had skin in the game might have worked a little harder before going to the market and raising capital at such, unattractive times, little things like that. So it was a combination of a lot of influences and reading experience that have got me here.
Well, Chris, I promise I'm paying attention, but I couldn't help going immediately to Amazon and looking for Sosnoff's books. Humble on Wall Street is apparently a collectible item. It starts at $116 a copy. So
okay, that's
I'm
not
gonna
that
hold
bad.
off on
I've actually seen it higher.
No
I think
kidding.
I
That's
think
a
I've made
bargain.
the market for. Yeah, I think I've made the market
Good.
for that book. Maybe it's come down along with everything else.
Yeah.
So
How about
yeah,
that?
I met him before too.
Yeah.
When I was writing my newsletter way back when, I visited his office, and
Oh.
he was very generous. He spent over an hour with me. He loves to talk about art. He's very much into art, and he likes to draw lessons from the art markets to the stock market. And he's got lots of stories where he bought certain paintings and left them alone for a long period of time and were worth a lot of money. So as you can see, that's probably very applicable to investing, where we see the prices all the time, but if you just kind of bought something and socked it away, then it might be a better outcome for a lot of people, similar to art.
Yeah, it's that lesson comes from all directions and all strategies. Even the the tale of Jesse Livermore. I forget what it's called now.
Yeah.
That famous book about Jesse
Yes.
Livermore, that where they don't name him explicitly.
Right. By Edward Lee
He's
Fever.
right, the fever. And he says I always made my money in the sitting, not in the buying or selling, right? The sitting, he says. So even that guy who traded his way to like 3 or 4 bankruptcies or something knew that making money was about just sitting on a position that's working, and with you, it's sitting on a business that works, right?
Right.
Over the long term.
Right. I mean, this is one of the things that always fascinates me about investing generally. Like, if you just look at businesses, and I know this is in Thomas Phelps' original 100 to 1 in the stock market, and he did this with like Pfizer was his example, and he just had some basic financial data like net income, sales, ROE, like earnings per share, really basic stuff. And it was every year, I don't know, like a 20-year span, he put these numbers out. And if you just looked at that, of course, you'd never sell it. Okay, yeah, it didn't mean that it went up every year. Sometimes, maybe net income was down a little for that year, but it was still perfectly within a band of expectations. Returns were good, return on equity and all that was good. Of course, you would have left it alone. But, stock price was all over the place during this time, cut in half and up and down. And if you just left it alone, you were up like 25x or something more than that. It was crazy. Yeah. And I see that even in stocks in my own portfolio. I mean, I wrote about this recently to my investors. I share with them some examples. And just in the 7 years I've had my fund, there have been stocks where if you look at our overall IRR over a 5 or 6 year period, it's like 21% compounded. But in the midst of that, I had to suffer a 45% decline, a 55% drop in one case. It's astounding. But again, if you just looked at the business, you would never see that. The one that fell 45% actually increased earnings per share every year that we've owned it. So if you just looked at the business and you looked at the sales, you looked at earnings per share, looked at margins, you would never have guessed that somewhere in that run, there was a 45% drawdown from peak to trough. But if you just left
Yeah.
it alone, you've got about a double in 5 years. So, which is perfectly fine.
It's perfectly
Yeah.
fine.
Yeah.
Yeah. And Chris, you of course wrote a great book too here. One I read a long time ago, 100 Baggers, where you talk about a lot of this, a lot of these ideas.
Yeah, and that came right out of Phelps's
Anecdotally,
book. That was the inspiration, was to update that what he did. So that's how that came about.
yeah, and I was looking back through it once I knew you were coming on. I had earmarked some pages back when I first read it, and the first one I got to was when you tell the story about Monster. I know you've probably talked about this a lot, but just and then I remember reading that for the first time and kind of being blown away by it, because that's one of the names that I think a lot of casual investors hear about. When they see these long lists of top returning stocks over the last 10, 20 years or whatever, but Monster. And I was wondering if you could just use that maybe as a brief example of why that company turned out the way it did.
Yeah, well, I always remember the great thing about Monster and about that particular example is that you had years to buy it and still make 100 times your money. And it was evident, like in the financials, it was very clear. This company you saw very large, fat margins, big growth, and it was years it was going along like this. So you had a chance to buy it during all that time. It was like right out there in the open, which sometimes, it's not always the case, but in this, you could really just see it, and you had so much time. That's one of the things I take. I think that's one of the things I take the most from Monster. And of course, it wound up going up many more times than just 100. I think it was up, 700 times at some point, and maybe he's up more than that now. I don't remember. But so the lesson there is, when you find a really great business, you have a lot more time than you think. It could be, just think if you had looked at Monster and it was up 10x and you thought, well, I've missed it. That would have been a shame, right? But focusing just on the business, it had huge, what we call TAM, total addressable market. That's the other thing about Monster. And, it was making deals with distributors. And so there was definitely a story there that you could follow. But the other thing that was interesting about Monster was there was quite a bit of skepticism about it for a long time.
Yeah.
And in the book, I pointed out, I think there was a Value Investors Club write-up that was very negative on that stock and the competitive position of it. So even though it had these large, very thick margins and on paper was doing very well, there was still a lot of skepticism about the durability of that. So those are some things that come out of that case study. But that was one of the interesting ones for sure.
Yeah. When I think of energy drinks, of course, Red Bull was the ultimate example. And the classic story, that goes around about that is that people tasted it.
Yeah, that's right.
It. And it's
That's right.
terrible. If you've ever tasted it, it's terrible.
That's exactly right. I remember that. That's part of it too. People look at it, they taste it, it was terrible. It was like, how
they
could
said,
this
nobody's going to drink this.
Yeah,
right?
that's right.
Yeah.
That's right.
And everybody drinks the damn stuff. I mean, I don't get it. It's just, I don't personally get it. So
right. Yes, that's one of those things where maybe the Peter Lynch style of trying the product itself didn't help you.
No, it kept you away from a huge winner. Yeah. Wow. I mean, they're the only one. If you watch Formula One racing, they're the only one with two teams in the field, and
right.
there are very few. There are only 10 teams.
Right. Of course, the other thing about Monster, and this is true of all these big winners, is that it suffered multiple drawdowns. And I know in the book, I remember I went through it. I had a little heat map where I showed them, and I mean, it dropped 40% multiple times during its run. So yeah, I mean, I'd say like two big lessons out of that book that I've learned about these long-term winners. One is they all go through those periods where you have these massive, getting cut in half type drawdowns. Even Berkshire has been cut in half at least 3 different times.
Mm-hmm.
But you also had long stretches of boredom, which is also, I think, just as bad. It's just as tough, maybe tougher, to hold on to a stock that goes nowhere for 5, 6, 7 years. I mean, that's hard. And there were a lot of
Yeah.
times that happened. I've done this with my stocks as well, where I've gone back and I think it was Brown and Brown. I did one of these case studies on where in a 16-year stretch, it was up. I don't remember the numbers now. It was up a good bit, many times, but there was a 6-year stretch in that where it went nowhere from peak to peak. So, that's hard. When you're
That is.
watching other stock, you're looking at other stocks, there's always something going up. I mean, Berkshire was the best performing stock in that study and it had a 7-year run where it went nowhere in like late 90s. Remember when the tech boom was going and the S&P was up 200-300% during that time and Berkshire went nowhere. That's tough to hold, but that was the best performing stock in the study. So you can imagine, some of the other top performers that weren't quite the best have longer stretches of underperformance. And it's just, kind of normal, natural. You have to get used to it if you're going to be a long-term investor
This
and make
call
these really good returns.
this calls to mind the great quote of William Goldman, right? Nobody knows anything. He was talking about Hollywood, but nobody knows anything. Nobody knows anything about the price of securities, the direction of the price of securities. Nobody knows anything about it. And if you make decisions based on it, well, you're making a decision based on something you yourself do not know, and that nobody knows.
Yeah.
It's not how you do it.
Right. I
Simply
mean, over
put.
the very long term, we know that stock prices generally will follow the business performance, right? You're not going to create a great business like Costco or something and not have the stock go up over time. But there are stretches, of course, that can go in days, weeks, months, years where they can be decoupled. And that can
Yeah.
be very frustrating.
Yep. And great, fantastic businesses like Costco, if we're going to stick with that example, they can become, extraordinarily cheap and still be a fantastic business. They can become extraordinarily overvalued. And, if you buy at that peak, you're not going to perform for a long time. But the business keeps chugging.
Yeah.
It's just like, it's got to be intensely frustrating, for
Mm-hmm.
people to look at that and be expected to not do anything. So we often wind up here in these discussions where we have to admit that investing is, I would say it's technically not extraordinarily difficult, but it is emotionally downright near impossible for most people.
Yep.
Most people don't.
I
Yeah.
totally agree. I mean, sometimes I think that's my role. Like the biggest service I provide for my investors is just getting them to just stick in there and leave it alone, and and be kind of like, almost like a shrink, bucking them up when times are bad, and not letting them give up. So, but yeah, I totally agree. Just like the basic principles of it are pretty simple. If you just buying a basket of great businesses, leaving them alone, or even you don't have to do that. You just buy the index fund and you leave it alone. That part's not so difficult, but the emotional toll and the ability to resist doing something. That's the thing. People want to do something, and the ability to resist that's hard. And the emotions going through it, like we're going through it now. Things are in free falls. It looks like some kind of economic catastrophe is unfolding before our eyes, but we've been here before. And I think, again, if you have that multi-year outlook, you look out 5 years or so, this is going to be another blip, just like COVID, just like other things we've seen happen before.
Yeah. Yep. Nothing new under the sun. Chris, before we hit record on this, I was asking you about the books on the shelf up behind you. You are an avid reader of philosophy.
Yes.
Does this have any? Is this a hobby, or does it integrate with investing at all?
Wow, that's a good question. I mean, I started it just kind of as a hobby and as an interest, but of course it plays into everything in life. I mean, not just investing, but everything. So it is very important. And I mean, taking that more philosophical outlook about things, I think it makes it easier to go through those difficult periods for sure. And different
I hadn't
philosophers have
thought of
different
that.
things to teach you.
That,
Yeah.
that's good.
Yeah.
Yep. you better be philosophical about it when you're getting, you're getting beat up like, Trump tariff tantrum.
Right. That's right.
This too shall pass.
That's it.
Perhaps.
That's it.
Yeah. I was
Yeah, I mean,
emailing.
I think lots of different things with these philosophers. You learn different things. I mean,
Yeah.
the pragmatic philosophers teach you different ways to think about things. Platonists are different. So, yeah, I really enjoy reading a lot of these different things and thinking about them. And then, yeah, they spill over inevitably into what I'm doing.
Is there one that really sort of speaks to you as a market philosopher who didn't know he was one? Let's say.
Well, I've written
I
a
know,
couple
for
of books.
example, I know you're into
Go ahead.
Korzybski, right?
Yeah, I was just thinking that.
Yeah.
Just thinking of him. And I've written a couple of books about Korzybski, of course. So he there's a lot in there that you can apply to markets. And of course, he didn't know it at all. Well, he didn't address that audience at all, which was the perfect avenue for me to write my book, How Do You Know? Which I did. And I wasn't the first one to try to do that either. It was somebody else who tried it in I forget the date now. Was it late 50s or early 60s, or someone else tried to write a book? And it was actually McGee, the same guy who wrote the book on technical analysis, the Bible of Technical Analysis. But he wrote a book, and it was called General Semantics on Wall Street. I remember that was the first edition, and I always chuckle because that didn't last very long.
Yeah.
And there was a second printing that came out, and it was called Winning on Wall Street. So he knew to drop the general semantics was not a good, not a selling
Yeah,
thing to put on the
nobody
cover.
cares.
Yeah, nobody cares. Nobody
How to
cares
make
about that.
Right
People not
degree for
care.
the second edition.
Yeah,
Wow.
right.
Yeah.
It
So
couldn't
wait
be
a
a
minute,
worse
Chris.
book title.
On Woodlock Family House, Woodlock House Family Capital, I see 100 baggers, invest
Yeah.
like a deal maker. How do you know? And World Right Side Up are you
Yeah.
saying World Right Side Up is also influenced by Korzybski? What you
No,
said?
it was just had two books. The other one I wrote was probably not even on my website. It's a book I wrote published by the Institute of General Semantics, which is Korzybski's institute that he started in the 1930s. And that book is called Dear Fellow Time Binder. And it's available.
I have that on the shelf. That, yeah.
Yeah.
I forgot.
Yeah,
about
How Do
it.
You Know is also now published by the Institute of General Semantics as well. So
Okay.
those are the two
All
books that are really directly, related to Korzybski.
All right. I want to make sure I have the complete works of Chris Merriman's Semantics is all. So,
yeah.
Very good. You want to talk about a stock or two that you like now?
We can do that. I don't care.
Or maybe I could ask you to talk about Swedish companies, just to say a few words about Swedish companies.
Yes. So I got interested in Sweden because there were all these winners from over there. And so, I'm doing not only these 100-bagger study I did, but then other studies I've read, I've been reading, and I get interested in this kind of things. Well, these top performers. And I came across a chart where there are a bunch of Swedish companies that outperformed Berkshire. I wish I could kept the original chart that I found. And it wasn't like from inception, but it was over like a 20-year period of time or something like that. And there were these, for lack of a better word, kind of holding companies that grew a lot through acquisition. And they had names like Lifco and Lagerkrans and AdTech and Indutrade. And I was like, wow, what are these things? And so, I started to investigate more in Sweden, and turns out there are a lot of winners there. It's a very good market. In fact, I saw a study not long ago which looked at stocks that had gone up at least 1,000% in the last decade. And of that population, Sweden had contributed something like 20 companies to that population, which was like a 4.5%. It was way oversized based on the market cap. So there was the big ones. It was like the U.S., China, India, and I think Japan. But the fifth most contributor was Sweden.
Who knew that there were even 20 publicly traded Swedish companies at all?
There's only like 10 million Swedes, but they produced a number of these winners. So
that's amazing.
Yeah. So, like Lifco is an example. It's one I own, and that was my first purchase in Sweden, and it came in 2021. And it's a really great company. It's half owned by Carl Bennett, and other insiders own some stock too. So you have the skin in the game element, not leverage. They do a lot of different things. So it's a holding company. They have over 200 different businesses. Some of it they do in like dental supplies, so like the cement that goes in your teeth when you go to the dentist for get fillings and things, they make that. They have all these other industrial parts and segment fittings and things that they make. So it's a very broad, diversified business. And they take that cash flow and they reinvest and they buy other businesses and they just kind of keep going. So it's kind of like in the U.S., maybe the closest kind of equivalent would be something like a Danaher or a Roper. These kind of businesses that they grow primarily through acquiring other small niche industrial businesses. And so it runs this very decentralized model, which is a very Swedish thing. It's decentralized. They're called Swedish serial acquirers. That's what people call them. I'm not necessarily that fond of that name, but that's what it is. I prefer to think of them more as they're buying and building businesses kind of, as they go along. But yeah, I mean, Lifco has been, and by the way, it's also global. It's not like it's just a Swedish thing. So they do business all over the world. But it's a very solid business, generates lots of cash. And then they reinvest a good chunk of it and generate good returns on capital. And it's a machine. I mean, they've been doing this now. If you look, I think it went public in 2000. I don't remember now, 14 or maybe a little earlier. But I mean, it's been a great winner on the stock market. And so that's one example. Cool. And there's other smaller ones too. So you can kind of, if you poke around, you can find ones that are a little earlier on the curve. I'm on the board of one of these small publicly traded companies. So I don't want to talk my book too much, but there's also an interesting one called Technion. TEQ is the ticker over there. And similar to Lifco, except much earlier on. So there were only 30 businesses there, around 30. We've done some acquisitions this year. So, I mean, that's the kind of thing you can find over there. And it's been very interesting. And again, there are lots of skin in the game. All these companies are owned. The owners, the management team are owners, own a good bit of stock. They're not leveraged, generate cash, all the beautiful things we like about businesses that they seem to exhibit. So
interesting.
I make many trips to Sweden in a year. I go at least 3 or 4 times, at least 4 times a year. Last year, I probably went more than that. And that's a good market to fish in. And again, everyone speaks English. The disclosures are all in English. So the disclosures are good. It's a good market that way.
Very interesting. And only 10 million people and all those winners. There must be something in the water in Sweden.
Yeah. Well, there's a lot of theories about this, but one is there was this company called Bergman and Beving that got started in the early 1900s, and fast forward, they were the first one to kind of discover the power of this decentralized model, and then buying other small industrials and kind of reinvesting and doing that. And so they were so successful, and then they had spin outs. So, AdTech and Lagercrantz are spin outs of Bergman and Beving, and they've been very successful. So I call it kind of like the Silicon Valley effect. It was like, you just had these tech businesses that happened to be successful in Silicon Valley, and it just attracts talent there and copycats. And now we associate Silicon Valley as being a tech haven or center. And this kind of similar thing happened there. They had this model, it was very successful. Other people sort of copied it, drew similar talent there. And so now there's a proliferation of these kind of models there that have all been very successful.
I have a question that I forgot to ask you earlier when we were talking about the code, if you don't mind us just quickly backtracking that before we move on. I wonder, have you ever or would you ever own a company like TransDigm, which is a levered company, but Nick Halley is a brilliant guy and had a fantastic idea and has executed on it quite brilliantly and does some of these things that you're talking about.
Absolutely.
But he pursues this, he likes the private equity sort of model, and he pursues that, with reference to leverage, dividend policy, and just the way he thinks about the business. Would you ever own that? Have you?
It's a great question, and I've looked at it many times, and I would say no. I mean, I TransDigm, the kind of counter to TransDigm is Heiko, and I own Heiko, HEICO, which is a similar. I mean, they're often put in the same bucket of their different businesses, but and they've both been very successful. Heiko has done it with very little leverage, and TransDigm done it with eye-watering leverage for me.
Yeah,
But I
yeah.
cannot deny, that's been successful. It's like I tell people, sometimes this just comes down to personal preference. It's like, do you like deep dish pizza or New York style pizza? It doesn't mean one's
Right.
right, one's wrong. And so TransDigm has a formula that's very successful, and I don't deny that
There,
it's been very
there's an
successful, and I expect it will be
right.
successful, but it's just
There's
not
an
my
interesting
flavor.
philosophical. Sorry. There's. I didn't mean to interrupt, but there's an interesting philosophical point here for me. As you say, it is a personal preference. It's partially about investing in things that you understand, and you understand, founders who don't like a lot of leverage, right? Which is great. I love that idea. But I wonder how much can I ever understand TransDigm because, a lot of leverage, things can happen that you can't anticipate.
Mm-hmm.
And so how much can you ever really know? Even if they're brilliant, they have a great track record, they have a culture that has really executed very well. And I wonder, you know, because I have it in the extreme value portfolio. I think they're brilliant. I think they've done a great thing. I do have that straight line from the founding to the present moment that I often like to see. But I scratch my head about the leverage now and then because I think how much, they've done it the whole time. But you and I both know that distaste for leverage and the, wanting the well-financed business, it's about all the things that you don't know can happen, the things you may
Yeah.
have to ride out. So I'm in a philosophical quandary about it constantly. Just
Right.
not a question, just,
No, I also say, like, well, I'll tell people, like, you have to come up with some sort of investment philosophies. You have to have some principles, and then you have to recognize, because these principles will also help you filter out the investment universe. As you know, there's tens of thousands of securities. We have to have some way to get to some manageable number that we can work on. And so you have to also recognize that whatever principles you choose or filters you choose, you're going to miss out some great winners. My aversion to leverage means I've missed out on some fantastic winners, or the owner operator thing. There have been some great winners where the management team has had very little skin in the game, the way I would define it. But I'm okay with that because I'm looking at it as something that is a long term that I have to repeat again and again and again and again. And like you say, there are going to be times when it's going to be very uncomfortable to be leveraged. We both been through the 2008 crisis, and in that period of time, even an okay balance sheet became a problem very quickly. So, I would rather not have to deal with that. Also, it folds into a lot of other things on how you do investing. Like, I run a very concentrated portfolio. I have 12 stocks. The top 5 are half of it. The top 3, I think, are about 33%. About 11%, and 2 are about 11. Yeah, around 11% the top 3 each. So, I'm not going to, when you have a structure like that versus a structure where you have 30 stocks, you think about it a little differently, maybe. Some things you can't put in a concentrated portfolio, but you might put it in a portfolio with 30. And, there are different ways that you have risk management things in different ways. So, it all kind of fits together as one way I would think about it too.
it does.
Yeah, and having those principles, right, is so important in times like we're going through right now, right? Like, when you're maybe we're flirting with the bear market territory here. I've been hearing from people that I haven't heard from in a long time asking about the stock market, so I know that that's a panicky, fearful time, obviously.
Yeah.
And I think just right that just having those principles, right, is that part of how you get through these time periods too.
Yeah,
Like,
well, I would
when it
also
gets to
say,
6 months
like,
from now, you
absolutely,
look back.
absolutely, and I would say times like this is when people then tend to abandon those principles. So it's easy to follow the principles when everything's
Right.
going well. And the test of any principle is you stick with it when things get nasty, and that's
Yeah.
the challenge.
Right. Don't tell me your risk tolerance. Show it to me at times like this. Right.
I always like one of my favorite Mike Tyson quotes. He says, everyone's got a plan
That's
until they get hit in the mouth. And so
Yep.
everyone's got investment principles until the first bear market comes around. And it's,
That's right.
Yeah.
Yep. Yeah,
Yeah.
it's all a learning experience. Then you find out who you really are. It's just like, as you say, it's like anything else in life. You find out who you are under pressure,
Yes.
and many people are under pressure right now. Um,
Yeah, it's a great way to learn
so,
about yourself, and that you have to make your investment philosophy and principles have to match your own, personality, what you know about yourself. I know, like, there's some businesses I'm just uncomfortable owning. I mean, like most retailers, I'm just uncomfortable with that model. I don't, and I know that when things get bad, I'll have a hard time holding it. So I've learned over time. I've seen it, and mistakes I've made, and so I try to put myself in situations where I'm not going to be forced in that corner again.
mhm.
So if you're always thinking about that, I think that's a good guiding light too. There's some things if you're just not comfortable with, then that's fine. You just don't own those things. It's lots of
Yep.
other fish in the sea.
Right. It's Buffett's circle of competence. There's a clear boundary, beyond which you'd probably be better off, not going beyond it.
And I
Um,
would say my circle of competence over time has gotten smaller. It's like the number of
that's
things I
funny.
really want to own. Yeah,
Yep.
you would think it would get wider, like you'd learn more and you'd want. No,
Right.
actually, it gets smaller because the number of things I really want to own, it's just, yeah, you get more picky, I guess.
Right, but actually, I would say in describing that evolution, the circle of competence becomes clearer because and I'll only speak for myself, Chris, because I look back and I said, well, I thought that one was inside it, but it's outside it. So yeah, I can see how you say it's getting smaller, but you know, it
Clearer may
was
be a
it
better
was
way to put it. Actually, I
Yeah.
like
it was
that.
never
Yeah.
really inside the circle to begin with. I was just, wandering in the wilderness thinking I knew something that I didn't know.
Well, Dan, I
Um,
remember I have a memory. I don't know. This doesn't necessarily make us look great, but it's probably valuable for our listeners anyway. One of the
it is.
first
I
things
know
you and
what
I
you're going to
worked on
say.
together. Yeah.
Yes.
I want to hear this.
Yeah,
All right.
go ahead.
Oh, one of the first things we worked on together was like reinsurers, and we went to Bermuda and we met with all these reinsurers, and we did a bunch of research on that. And I don't know. I'm sure Dan agrees now, but in retrospect, I'm like, we didn't know. We had no business being there. I mean, we were way out of our.
Yeah. Yeah,
It
that's
didn't
one of
lead to
those.
successful investments, I think, for either of us. So we learned.
No, I mean, well, I was flat on. Oh God, I can't remember the name of the company. I blocked it all out.
Yeah. No,
I
you had
personally
one that
made a
was okay. It was like Partners or
yeah,
something. I remember mine was like Scottish Re, which was a disaster, and I got out of it before it completely unfolded.
right.
But there were, yeah, it didn't work.
Yep. Yeah. I wish I could
We did
remember
have
the
a good
name of
time
it.
in Bermuda. I mean, we met with a lot of companies, but and we
It
had a
was
lot of
that
fish
guy.
stew.
Yep. And yeah, fish stew. That was the best part of it. Was
That
Bermuda
was,
fish stew. We met with that one particular fellow who I felt taught us more about reinsurance than any other human being I've ever encountered in my life. And I don't remember his name,
yes, yes.
but I remember the company. And actually, in Extreme Value, I'm trying to look through the portfolio quickly. He, um,
I do have a
they
vague
wound
memory
up,
of this guy.
yeah, yeah. Um, I wish we could remember. We're gonna frustrate our listeners by trying to remember, but we actually sort of made a small single digit profit, as I recall, on that company. I'm sorry, I can't find it right now. And he just taught us. I'll never forget the lesson he taught us about these risks and with the geographical zones. He taught us about Hurricane Hazel. Started out in like Lesser Antilles or someplace and killed a bunch of people in, I think it was Haiti or Cuba or someplace, maybe Haiti. And then it made landfall in the Carolinas and went and killed 80 people in Toronto. And those aren't in the same geographical zone. So if you're writing X% of your net worth, as these companies do, per zone, you were way over your skis there on that Hurricane Hazel deal.
All right.
So the lesson there was, don't draw the zone like everybody else. you know you gotta know what you're doing when you draw a zone, which is a crazy thing. Okay, now we got to know weather patterns. It
Yeah,
just got
exactly.
more and more complicated, so that you could never say that you really knew anything.
Well,
I'm being-
yeah, that's the key takeaway for me for that now is it's just got more and more complicated, and you can never be sure that you really knew anything. And that pretty much sums it up to me as well.
yeah. and it's it's classic, classic um, Charlie Mungerism, right? To the too hard
Yeah.
pile,
And that was a long time
and
ago, by the way. That was like 2004 or 5,
yeah.
something like that. So, I mean, we've evolved as investors since, but that's an example
Uh,
of,
yeah, I
yeah,
also lied. We lost 14% on it in extreme value. Found IPC Holdings was the
IPC. That was
company.
it.
Yep, held it for 223 days and lost 14%, which is probably a fantastic result on average
Exactly.
for a
Exactly.
reinsurer.
Yes.
you know, it's like
Yep.
to invest in reinsurance companies, you have to be Warren Buffett. You don't have to be like him. You have to be him. you know, and he had his
Yes.
problems with him as well too. So that's now General Re wasn't exactly the greatest thing.
Hmm.
Well, you learned
Yeah,
and had some good fish
yeah,
stew
we
along the way.
did,
It
and
sounds like so. Yeah.
the fish stew was worth the trip, I think. And if readers bought the stock and lost 14%, but went and had the fish stew, I'm going to call it break even. So,
There you go. Yep.
all right. You got any other names that you think teach a good lesson for listeners, or that you're excited about, like right now?
Yeah.
But
I
you're not.
mean,
I have to tell listeners, Chris is not like the excited about right now pick kind of a guy. If I'm, he's the guy you
all
want to
right.
go to these long term lessons for. So put that in your notes too.
Yeah. Yeah. I mean, one of the things I mean, yeah, I mean, right now it's a lot. I would buy almost everything. I mean, so because everything's down so much. But I've gotten a lot more excited about a company called Lumine Group,
Oh,
Lumine, and it's a
hmm.
spinoff of Constellation Software.
Oh, really? Nice.
Yeah, yeah, and yeah, I've owned it since the spin. Like averages around probably 17 or something like that. It's $40 around right now, but
Yeah.
they I mean, they've grown. They have like a 35% return on invested capital over the last 3 years. They've invested in a ton of money, and I think that it's just going to be a surge in free cash flow here in the next uh, couple of years. So I think that's one I'm particularly excited about. It's a lot of growth. The other one is a kind of a sister company that would be was called Topicus,
Mm.
and
I thought that one might
that's
come up.
yeah, that's also one that should have a big surge in free cash flow. It's also a spinoff from Constellation.
Hmm.
And I've owned that one since the beginning as well, added to it. But I think both those are pretty timely right now because, yeah, again, they've made all these investments. They've deployed a lot of capital last year, particularly for Topicus. And if you just do kind of back of the envelope math based on the returns they've gotten in the past when they deploy capital, they're making 25% or so returns on this capital. And you project that forward, there's going to be a big surge in free cash flow this year and next year. So, and I don't think the market quite fully appreciates it yet. And but yeah, those are ones that I would expect to own for a lot of years. So like you just said, Dan, I'm not saying buy right now. Like
Hmm.
then you're going to make a return in 3 months and sell it. These are really good businesses that should compound capital at high rates for a long time.
All right. So before we get to our final question, I have the penultimate question for you.
Okay.
Or maybe it's a comment and you could expound a little bit on. This is for our listener. Please notice that we are talking with Chris in the midst of the Donald Trump tariff tantrum, and the market is down substantially, and it's wildly volatile from day to day. It's red and it's green and it's up and it's down. And you have not heard Chris mention that one single time. Why, Chris? Why have we not heard you mention that one single time?
Yeah, that's good. Good point to make. I think right now I saw just this morning that it's a fourth worst start to the U.S. market in history. History being 21st century and 20th century.
Hmm.
Yeah, I think the top two are like from the 1930s, and then the third worst was 2020, and now we're the fourth, which is kind of amazing.
It is
But
amazing.
I mean, one reason why is because it doesn't change anything that I'm doing. Like I haven't, really touched the portfolio this year as far as selling anything, and I don't anticipate doing anything. So for me, I mean, I don't want to say it's a non-event. It's important. Things are happening, but
Mm-hmm.
it's not like making me want to run out and sell my stocks or make a switch somehow. So that's probably the biggest reason. It's not in the actionable category for me. It's not, at least not yet,
Yeah.
that I can
It's
see.
not. Wait a minute. That was interesting. It's not in the actual category for me. What do you mean?
Like an actionable category. Like
Oh,
it's
an
not something that.
actionable. Okay, I see. I'm
Mhm.
sorry, I didn't
Yeah,
hear you. Okay, it's
yeah.
not
It's
an
not
actionable category of news or information.
right. I mean, because when I'm looking, because I'm studying these businesses primarily, and so
Mm-hmm.
it's not. I'm not gonna, like I said, I'm not gonna run out and sell any of these businesses because they're down. Whatever 15% or whatever it is from their highs. And of all the stuff we've been talking about, I mean, this is really normal for equity investors.
Mm-hmm.
These things happen from time to time, and we've had more in our share of it lately than usual. I was thinking about this the other day. I was saying this is my 7th year running the fund, and I've already had 3 bear markets in that time, which is unusual. That's a lot of bear markets. Usually I have like one, you know.
Yep.
So, but it is still normal when you take the longer view. I mean, it's
Yep.
so as you said before, this too shall pass.
Yeah. All right. So with the penultimate question out of the way, let's do the final question, which is the same for every guest, no matter what the topic, even if it's a non-financial topic. Same identical question. If you've already said the answer, please feel free to repeat it. And the final question is simply, it's for our listeners' sake. If you could leave them with one final idea, one final takeaway, what would it be?
No, I mean my big takeaway, and I often will say something along these lines, is the key word for all of this investing is patience. And if I could boil it down to one thing, it'd be that you have to be patient. It's like, when you plant, uh, flowers or something or vegetables, you
Mm-hmm.
don't expect immediate results. You have to give it time. You plant a tree, you have to give it time to grow, and they're going to be good growing seasons and bad growing seasons, and it's going to be winters and the springs and summers, but you don't pull it out, or you have to give it time. So I think the biggest thing for any investment strategy or principles, or however you decide to tackle the problem, is you have to find ways to cultivate that patience. And there are lots of ways to do it. I mean, I give them one little crutch I like is that coffee can portfolio. Dan, you know about this. If you Google it, the coffee can portfolio will come right up. It was an article it came out in the 1980s, but the basic idea is you create a portfolio with the intention that you're not going to look at it for like 10 years. Just leave it alone and see what the results are. And there's been lots of people have run these different experiments, but invariably what happens is you have something in there that's a huge winner, and you have a few things that don't work out. Maybe you have a 0 or 2, and then you have a couple things that are mediocre, then you have a couple of really good performers, and by the end result is that it's much better than if you had been messing with it the whole time. So that's my key lesson. Find a way to cultivate patience with your investments, and I think you'll be happier with the results, and I think you'll be happier just in life generally. You'll be less worried about stuff,
Yeah.
especially with Trump tariffs and all the other things that go on. So that's my parting thought.
Excellent. Yeah, I hope people take you up on that. I think it's Robert Kirby was the guy who
Yes.
wrote the article, and he described two clients who were husband and wife, and they had both taken the buy advice of the same advisor in separate accounts. The husband never sold anything, and the wife took the sell advice. And the husband, upon his death, she found out he had dramatically outperformed and wound up with the portfolio you described. The zeros, the mediocre, the really good, and the phenomenal outperformers. Really
Yeah, but I
interesting.
think there was one stock in there that was worth more than the wife's account entirely. So,
Right. That was the Xerox and its spinoffs, I think.
yeah,
Was
yeah.
that. Yeah.
So it's the
Yep.
lesson.
Yep. And it seems like you're pursuing something like that. You've got your, your big winners and their spinoffs that you're holding.
Yes, I do. Yeah,
Yeah.
that's right.
All right. So we got another coffee canner sitting right here, folks. You should learn all you can from him. It's always a pleasure to talk with you, Chris. Thanks for being here.
Yep. Great talking to you, Dan. Great talking to you, Corey. Thanks for having me on. And yeah, it was a pleasure.
Okay. Well, next time we're not going to wait
you.
4 years. Okay.
All right.
All right.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.